James and his college roommate Owen started at the exact same financial point 15 years ago. Both 30 years old, both with $50,000 saved, both earning similar salaries in the same city. James used his $50,000 as a down payment on a rental property. Owen put his $50,000 into a total market index fund and set up an automatic monthly contribution. Neither of them touched the other's strategy. Neither tried to convince the other they were wrong. 15 years later, both of them in a genuinely strong financial position. And the honest answer to which strategy worked better is more complicated than either side of this debate usually admits. This video runs the real numbers, not the highlight reel version either camp shows on social media, but the complete math, including everything that gets conveniently left out. James bought a $250,000 rental property with his $50,000 as a 20% down payment, financed at a 30-year rate near 7%. His mortgage payment landed around $1,300 monthly. He found a tenant paying $1,800. On paper, that gap looked like $500 of monthly profit, and James felt like he had figured something out that most people never do. Owen's $50,000 went into a brokerage account with an automatic contribution of $300 monthly. There was no story to tell at dinner parties, no keys, no tenant, no property to drive past, just a confirmation email and a number that moved slightly every few months. This difference matters more than the eventual financial outcome because it shapes every decision both men made over the following 15 years. James's investment felt tangible and impressive. Owen's felt invisible and unremarkable. That psychological difference has real financial consequences because how an investment feels influences whether you stick with it. By year 3, James had collected real rent and made real mortgage payments, and on the surface, his gross cash flow looked like a meaningful return on his $50,000 investment. Then the real costs arrived, the ones that never make it onto the simplified version of this story. Property taxes ran roughly $3,000 annually. Insurance added another $1,500. A water heater failed in year 2, $1,200. A roof leak in year 3, nearly $3,000. 1 month of vacancy between tenants cost him the lost rent, plus relisting fees. And James managed the property himself, which meant evening phone calls, weekend showings, and coordinating repairs during his lunch breaks, hours of unpaid labor that never appear in any cash flow spreadsheet. After every genuine cost, James's actual net cash flow over those 3 years was a small fraction of what the simple rent minus mortgage math had suggested. Not nothing, but considerably less than the number that gets quoted at barbecues. Owen, over the same 3 years, did nothing except let his automatic contributions continue. His portfolio, growing at a historical average market return, had grown meaningfully without a single phone call, repair, or vacancy. Here is what Owen does not have that James does: leverage. James used $50,000 to control a $250,000 asset. As that property appreciated, even modestly, his equity grew on the full value of the asset, not just on his original investment. This is the single most powerful structural advantage real estate holds over stock investing, and it is the reason this comparison is never as simple as either side claims. A relatively modest down payment controlling a much larger appreciating asset means the percentage returns on James's actual cash invested can outpace what the same dollar amount would have earned unleveraged in the market, as long as the property performs reasonably and the costs stay manageable. but leverage cuts in both directions. It also means James carried $200,000 of debt, concentrated his investment in a single asset in a single neighborhood, and exposed himself to risks that a diversified index fund investor simply does not carry. A complete and honest accounting of rental property ownership includes several categories that rental property advocates consistently underweight. Vacancy averages roughly 1 month annually across the rental property market, a full mortgage payment with no offsetting income. Maintenance and repairs typically run 1 to 2% of property value annually, which on a $250,000 property means several $1,000s most years, occasionally spiking into 5-figure emergency repairs that cannot be deferred. Capital expenditures, roofs, furnaces, water heaters arrive in large, predictable but unscheduled chunks that require dedicated reserves to handle without financial strain. Property management, if outsourced, costs 8 to 10% of monthly rent. If handled personally, it costs unpaid hours that have genuine opportunity cost. And a single bad tenant who stops paying and understands the eviction process can erase an entire year of profit through lost rent and legal fees. None of these costs appear in the simple cash flow number landlords quote casually. All of them appear in the actual bank account over time. By year 10, James's property had appreciated to somewhere in the mid-300,000s, with his mortgage balance paid down enough that his equity sat in a meaningful range, built partly through appreciation, partly through leverage, partly through his tenants effectively paying down his loan over the decade. Owen's portfolio, with consistent monthly contributions and compounding market returns, had grown to a comparable range, entirely without debt, tenants, or a single emergency repair call. The two men, a decade in, were in roughly similar financial positions, despite completely different paths to get there. James had worked considerably harder for his outcome, taken on significant leverage and concentration risk, and absorbed the stress of property ownership. Owen had done essentially nothing beyond setting up an automatic transfer and resisting the urge to sell during market downturns. By year 20, both investments had grown into substantial 6-figure positions, broadly comparable in total value, despite very different journeys. James's equity reflected 2 decades of appreciation, leverage, and the slow paydown of his mortgage by tenant rent. Owen's portfolio reflected 2 decades of uninterrupted compounding on a much smaller total cash outlay.
The detail that changes the comparison most dramatically is if Owen had simply increased his monthly contribution by a modest amount partway through the 20 years, his ending balance would have grown substantially more. Because in index investing, additional contributions compound automatically. In real estate, scaling up typically means buying a second property, taking on a second mortgage, and doubling the operational workload. The stock market scales with money. Real estate scales with money and labor simultaneously. Index investing carries real volatility that is genuinely uncomfortable to live through. Major market downturns have produced drops of 30 to 40% within months during past crises, and the data consistently shows that many investors panic sell during these periods, locking in losses precisely when patience would have been rewarded. Index funds also produce minimal cash flow, a small dividend yield that does not replace anyone's income, and carry no leverage, meaning every dollar invested only controls that same dollar of asset. Real estate carries illiquidity, concentration risk, ongoing management burden, and exposure to local market conditions that diversified stock investing simply does not have. It also requires genuine operational competence, tenant screening, expense budgeting, and the temperament to handle unpredictable costs and occasional difficult situations. Real estate's specific advantages, leverage, certain tax benefits like depreciation deductions, and the ability to roll gains into new properties through specific tax provisions are genuinely powerful in the right circumstances. They are also frequently oversold by people who skip the maintenance, vacancy, and labor costs when presenting their returns. The honest answer is conditional rather than universal. Real estate tends to outperform for people with local market knowledge, the time and temperament to manage property, and access to markets where rental yields genuinely support positive cash flow from the outset. Index fund investing tends to deliver comparable or superior risk-adjusted returns for people who want simplicity, liquidity, true diversification, and zero ongoing management burden. James and Owen are both in strong financial positions today. Neither path was wrong. What matters is not which investment wins in the abstract. It is whether your own analysis, before you commit real money, includes every cost honestly, rather than just the ones that look impressive on a thumbnail. That complete honesty is the only version of this comparison that actually helps you make a good decision.